It was a tough day here in the United States. Not only did the stock market go down, but more importantly, of course, most people have heard the news that there was a suicide bombing over in Afghanistan, and 11 or 12 members of the U.S. military unfortunately lost their lives. And of course, there was some loss of lives on the Afghan side as well. So just kind of took the air out of the room, so to speak, and had our minds in other places other than the stock market. But stock market did continue to play through, and we'll take a look at what that means for our posture here today. We did have the NASDAQ composite hit a new all-time high before turning lower, but at the end of the day, most indices were in the red. For our trade application example here tonight, I did want to focus on what I think is one of the more interesting value opportunities within the dividend growth investing world with a sold put opportunity here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 26th, 2021. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below in our description area and sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZ, and I would encourage you to follow me if you're not doing so already. We really appreciate those of you that click like and retweet on those Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see embedded in the logo in front of you. All right, let's go ahead and get into today's trading activity. Here is our heat map from the S&P 500 in this case today. Give us a general sense as far as where we saw any sort of patches of green or red to determine what was kind of leading or lagging within the market. And the first thing that hits me when looking at this is we see a lot of red today, right? There's not a lot of green out there that we can embrace. There were a few positive ones that from the bigger market caps. Amazon was up 0.5% today. JP Morgan was up 0.5% as well. CRM, which of course is in the Dow Jones Industrial Average these days, they reported earnings yesterday, and that was well received by the market. It was up 2.66%, so that was a positive there. And we saw maybe a few of the industrials, maybe the defensive areas, right? Lockheed Martin, Northrop Grumman, LH Harris. Those are all defensive or defense contractors, right? And so if there's a fear of more military action, perhaps some of those stocks are benefiting from the chaos that we saw here earlier today. But for the most part, we did have weakness across the board. Our worst performing sector today was energy. Not a surprise when you look at this little corner right down here in the lower right-hand corner. Those are all the energy stocks there in the S&P 500, and I don't see a single green block. So all the energy stocks, from what I can tell, in the S&P 500 were lower here today. Of course, Exxon and Chevron being the most well-known, both down about 1.3%. A piece. So not a whole lot to get excited about there, but after such a record run that we've seen on Wall Street recently, it's not a complete surprise to have a little bit of a day off and an opportunity to let the market breathe a little bit, inhale, exhale, and particularly considering the news that we heard overseas, not a surprise to see some sell-off here today. Let's get into the normal charts now. And so I'm going to pull up our 4-grid here. I'm using chart 4B for that, for those of you that are premium members that are following along at home. And as I mentioned in the intro, we did have an all-time high there on the NASDAQ briefly on an intraday basis. We touched 15,059. So just barely above yesterday's high, but as I mentioned earlier, it did end up selling off for the rest of the day. So touched a new high in the morning, but ended up lower by 0.64% here today. S&P 500 was down 0.58%. Dow Jones was down 0.54%, and then the Russell 2000, as is often the case, kind of moves around with more exaggerated movements. It was down 1.13%. Now, having said that, as you look at all of these charts, you'll notice that the background color remains dark green. So, that's a positive, naturally, if you're looking for more bullish price action and you're looking for relative strength. We've also seen more positive announcements here recently. I know that I just got done posting on Twitter that Altria did increase their dividend here today by about 5%. We also had Lam Research come out and their dividend by about 15%, and mentioned the earnings report there from Salesforce helping that stock along. And then I think Gap, the clothing company, came out with a strong earnings report after the bell. By the way, Peloton, one of the classic work from home stocks or kind of quarantine types of stocks that has caught the market's attention in recent years with the COVID crisis. That stock was down significantly after hours on their own earnings announcement. But for the most part, I would say that the news flow, economically speaking, has been positive, and it has been supportive of this market rally that we've been seeing here more recently. So we continue to have those strongly bullish postures according to the market forecast technical indicator. Also, I'd like to point out that the Russell 2000 now has a green moving average. So remember, the last time I was with you on Tuesday, right here, we didn't quite have that yet. Yesterday, it did switch from yellow to green here, as we now have enough upward pressure in the Russell 2000 to start changing the direction of the 30-day moving average. Remember, that's always a lagging indicator. So that's a more positive stance there. However, I'm going to kind of remain kind of more resolve in my prior statement, which is, of these four charts, the Russell 2000 still continues to be the one that I view as being a bit of a laggard, and I'm still a bit more concerned with. So we'll see if they can kind of break out of their funk. But for right now, the fact that you're trading kind of in the middle to lower end of the 3-month range versus these other charts that are very close to all-time highs does tell us that the market still seems to be a little bit more interested in maybe the larger cap and quality areas of the market. We talked about that yesterday in my factor-based swing trading class. That quality as a factor continues to lead this market. So stocks like Johnson & Johnson and Microsoft seem to be much more interesting to market participants than some of the smaller stocks that are out there. Also, I should point out that today, because of the nice trends that we've been in up until now, and then with today being a sell-off day, we did have a number of what's called bullish intermediate confirmation signals. And what we're looking for on those is a green line that is considered bullish. And remember, the green line can be considered bullish in two different ways. Either it can just simply be in the upper reversal zone, or it can be rising between the 20th and 80th percentile. So like down below here with the Russell 2000, that's an example of that latter situation where the green line is rising between 20 and 80. So we consider that to be a bullish posture, even though the green line's not in the upper reversal zone yet. Once you're in the upper reversal zone, then we don't really care if you're rising or falling. If you're in the upper reversal zone, we do think of you as strongly bullish. So that represents the other three charts that we have here. So the background color of all of these four charts tells us that we do have a strongly bullish posture on all four of them. And then the second part of identifying a bullish intermediate confirmation signal is asking ourselves, where is the red line? Now, the red line has to be in the lower reversal zone for these signals. It can't just be falling between 80 and 20 like the green line. In this case, the red line has to be in the lower reversal zone. Well, as you look at these charts, notice that all four of them have the same formation. The red momentum line, which is the most sensitive of the three lines that we track on the market forecast, all four of those red lines are in the lower reversal zone right now. So sounds good on the surface, particularly when I mention that the blue lines are between 50 and 20. You guys have heard David and I mention that there's different ways to determine whether that bullish intermediate confirmation signal are better or worse setups than otherwise. And typically what we want to see is that the blue line is below 50 but still above 20. What that's telling us is that there's enough of an exhale here where it's worth perhaps nibbling within the market. Because remember, the bullish intermediate confirmation signal is effectively a buy the dip signal, right? What it's telling us is that we have a trending market, a strongly trending market to the upside from an intermediate perspective, but the momentum line being down in the lower reversal zone is telling us that we have a sell-off in the most recent trading sessions. And so it's an opportunity for those of you that felt uncomfortable buying all-time highs yesterday to say, hey, let's look through the rubble and see if there's any opportunities with slightly better prices here today. So we like where those blue lines are positioned here today. That means that there was enough of an exhale. The downside is that the red lines are so far down that it kind of breaches another one of those ways that we try to identify better versus worse setups for that particular situation. And when the red line is below 5, that can sometimes spell a little bit too much pressure. And so like the red line up here is at 1.96 on the S&P 500. You can read that in the label there, and notice that it's at 2.36 on the Dow Jones Industrial Average. And then down below here on the NASDAQ, it's at 2.21, and then down here on the Russell 2000, it's at 2.13. So all four of those do kind of breach that concept where it's almost too much pressure in the short term, and it might lead to a little bit further of a pullback before we can get a bullish bounce. So it's going to be interesting to see how this one plays out. The blue line is supportive of the trade application, or the trade setup in this case, but the red line is not necessarily in its ideal spot. We would like to see that red line somewhere between 5 and 20 at the ideal location there. In all four of our cases today, it's below 5. So we'll have to take a wait and see approach. And of course, with news coming out fast and furious overseas, that could dictate trading as well. What we can see is that the S&P 500, which a lot of folks look at as, quote unquote, the market, there is still quite a bit of a separation between where it's trading right now and the 30-day moving average. If we were trading a little bit closer to it, I might make the assumption that we're closer to finding a bottom and we were more likely to bounce higher as a result. But with this air gap that we have here, it kind of gives you the impression that it might need another day or two of selling off before the bulls step in once again. So let's keep our eye on that situation. But obviously, some ugly looking candles out there. We close near the lows of the session, which is more of a bearish tilt towards things. And we'll just have to keep our eyes, on some of those earnings reports and the news stories for the futures markets to see how we open tomorrow. But long story short is we do remain with bullish postures from an intermediate perspective. We even have bullish intermediate confirmation signals, but obviously some controversial news stories that are affecting trading here today. Let's go ahead and take a look now at our 3 green arrows setup, and this will be chart 4D. And as you can see here, we have 3 out of our 4 charts with a 3 green arrows setup. The only one that does not have that feature is the Dow Jones Industrial Average up here in the upper right. Remember, you can look at the background colors to determine that. We have green background colors on 3 of those charts there. And so we do have green arrow number 1 on the S&P 500 for the 30-day moving average way back here on July 20th. We just received a green arrow on the MACD telling us that we had positive price momentum just here on the 24th, so 2 days ago. And on that same day, we also had a kind of a reversal there in the stochastic telling us that price was starting to close near the highs of its recent ranges. Got that green arrow there 2 days ago as well. So those 3 technical indicators are lining up more bullishly than bearishly right now, and this remains a fairly good time to be a trend trader in this market. So the only exception to that being the Dow Jones Industrial Average, where we do have a red arrow currently in place on the MACD, telling us that we've got a little bit of a loss of momentum up there, and that tends to make sense. You look at the all-time high on the S&P 500, it was just yesterday. All-time high on the NASDAQ Composite was just today. All-time high on the Dow Jones Industrial Average was actually back here 10 days ago. And so it's just not following the same bullish momentum higher as some of those other areas, and therefore that's being kind of noticed there by the MACD histogram. Let's go ahead and take a look here at our 1040 crossover method now. This is chart 4C. And we're in reasonably good shape here as well. The problem child remains the Russell 2000. As you can see, we've got the orange line and the blue line pinching together. So the orange line represents the 10-week moving average, and the blue line represents the 40-week moving average. these are 3-year weekly candle charts that we're looking at here. So when those two lines are pinching together like that, notice down below here on this PPO that we do have that green line drifting towards zero. Remember that dotted horizontal zero line that you see down there kind of represents where the crossover point would be of those two moving averages up above. And so generally speaking, you want to have the more sensitive line that tracks the smaller amount of data, in this case the 10-week period, or the 10-week moving average, be going up at a faster pace than the less sensitive line, which is the 40-period moving average. That's not what we're seeing here on the Russell 2000. Russell 2000 has not hit a high since back in March. And so we've really just tracked sideways there on the Russell 2000 over the entire summer, whereas that has not been the feature of the rest of the charts. The rest of the charts have continued to make new all-time highs. So Russell 2000 seems to be the one that is just not really acting in lockstep with the others, but the others seem to have a decent amount of separation between those lines where I don't really see any major red flags at this moment in time. Let's go ahead and take a peek over here at the internet. I always like to say thank you to those of you that help support us here on social media and other places, as these videos do take fairly significant effort out of David and myself whenever we do the videos, at approximately 3 hours a day, sometimes more than that when we're talking about all in on the time. So it's not just something that we take lightly. We do expect that if we're going to take the time to do the videos, that you guys are getting benefit out of that, and that hopefully we can get some benefit out of it as well. So if you appreciate the videos, we ask one simple thing out of you. Just click like for us there on Twitter. I figure if we're getting at least 100 likes, then it's worth our time to do it, and you guys didn't disappoint the last time around when I did it on Tuesday. 110 of you stepped up to the plate. So I appreciate each and every one of you. Keep up the great work on your end. Earlier today, David taught his portfolio management with ETFs class. So if you're interested in an ETF routine for retirement accounts and other things like that, and you're a plus or a premium member of Market Scholars, feel free to check out that recording. And then I taught my my question and answer session earlier today for our premium members. And we had a question about how to decipher the color coding system on my stock selector tool. We also had a question about California Water as a water utility business in the dividend growth investing space. We also had a question about how to think about value investing versus dividend investing, and kind of, how do we think about high quality with dividend investing, whereas the value investing oftentimes becomes kind of what we call a cigar butt style. And then we also had a question about how to set up a short selling trade on Texas Instruments. We looked at Blackstone, not BlackRock, but Blackstone from a trend trading perspective. We then had a question about Bitcoin and crypto and some of the things to be aware of and to watch out for, and some of the positives about it and some of the negatives as well. We also had a question about Amgen from Krishna, who inspired our trade application example in this video a little bit later on. Sorry to spoil the surprise there, but that will be our trade application example here in just a little bit. And then also a question about skin from Dennis, which, by the way, for those of you that took that skin trade, I believe that was exactly 2 weeks ago that I presented that trade application example. It was closed down at max gain here today, so congratulations to all of you who may have participated in that one as well. So if you have any interest in those types of questions and my answers to them, and you're a premium member, feel free to check out our Trading Rooms tab, and then you'll find my recording posted there. Tomorrow, David teaches his very popular technical analysis class at, I believe it's 1 p.m. Eastern Time, and so make sure you're tuned in for that. I'm sure he'll have lots of interesting things to discuss. Let's get back on track with some Thinkorswim charts now. And I wanted to do some 12 grid analysis here. So let's take a look at chart 5A. This will give us a sense of any sort of asset class movements that we want to be aware of here. So, as we look at this, I tend to try to look for important trend continuations or reversals. That's what usually catches my eye. One thing that's kind of interesting to me right now is there seems to be a little bit more resiliency here in interest rates. Some of you saw my tweet earlier today talking about how just in my lifetime we've seen 15% treasury yields all the way down to 1% treasury yields. And so yields are on people's minds all of a sudden, and we are starting to see some nice pop higher here. And that was not necessarily what I was going to assume, but that's why we look at the markets every single day. And right now, I will say that my mindset is becoming more constructive towards U.S. interest rates and a little bit more, a little bit more difficult towards my thoughts on long-term U.S. Treasuries. Now, that is kind of my mindset longer term anyway, so I don't want to make it seem like this is out of the blue and out of nowhere. Like I definitely think interest rates are going to rise over the long term, and I think U.S. Bonds are going to fall in price. But in the short term, it's a little bit surprising. Especially since we're having a bit more of a chaotic type of a day where it's kind of on your mind a little bit more, where oftentimes you think money is trying to drift towards safety. Maybe we saw just a touch of that here today. You saw TLT go higher by 0.28% here today. But as you're looking at the charts beyond just today, it does look like TLT is setting itself up for a fall, and TNX, the inverse of that, the interest rates themselves, are setting themselves up to start rallying. Remember how that can impact us with our various sectors out there as well. If you think that this is going to continue, then a place to look for opportunities might be the financial space. Whereas if you think that this is just a quick little flash in the pan and interest rates are going to roll over again very quickly, then that's where maybe REITs or utilities could be a better situation for you. So keep your eye on that story, because that seems to be a different tone than we've been used to for the last 3 months. We've been used to interest rates falling pretty consistently, and all of a sudden they're looking a little bit more stubborn. And so, when we looked at BX today, that was a very strong chart. Remember, that is it's a financial company that's more of a private equity player. But here's kind of what that chart looks like in the 3-month time period. And you can see it's been really acting nicely, bouncing up and off of those rising moving averages. And we come back over here, look at kind of a 6-month view to give you some more time to look at that. That's a nice looking chart right there. So Blackstone might be an example of a financial company that could benefit if interest rates start heading higher alongside some of the banks and brokers and insurance companies and other financial companies out there. So there's definitely opportunities. And like I mentioned in this presentation a couple of weeks ago, there's been 2 areas in particular that have caught my eye within the financial space. The capital markets stocks, which Blackstone belongs to, and then also the consumer finance stocks. Stocks like Discover Financial, for example, been acting pretty nice here recently, along with like Lending Club and a few of those others. So anyway, don't fall asleep on the financial sector, especially if interest rates start rising. In terms of other areas to focus on here today, I would say be a little bit cautious around oil. Oil was down 0.69% today as the US dollar was up 0.28% today. But in particular, I'd be a little bit nervous about where we're just hanging out here on oil. We're just a touch below that falling moving average. A lot of times that is an area where sellers will come in and use it as an excuse to pressure that stock, or in this case, ETN, back lower. So we had that nice oversold cluster signal here just on the 20th. We've now spent the last week doing a reversion to the mean type of a move, and now it's do or die time. Is this going to be a trend continuation to the downside, or will we break free to the upside? We'll find out sooner rather than later, because we're right at that key mark right now. Now, speaking of which, if we were to look at the sectors, look at 5C in this case, you can see from a sector's perspective, XLE is pretty much the same way. XLE was down the most from a sector's perspective today. It was down 1.52% today. In fact, all sectors were down except for real estate. Real estate just barely got above the break-even line. It was up 0.06% today. But energy was down the most. And you can see, similar to what we just mentioned about oil prices themselves, oil and gas stocks are at this very precarious location right on the underside of that falling 30-day moving average. It gives you the impression that there's a lot of selling pressure in these oil and gas stocks. So if you're looking to lighten up your oil and gas holdings, maybe this was your opportunity to do so after having that oversold cluster signal result in a reversion to the mean type of a move back up to there to a resistance area where it now looks like it's going to perhaps roll over again. Maybe this is an opportunity to put some bearish energy trades on as well. Now, energy can be affected out of news out of the Middle East, so we do have to be mindful of that. But just chart-wise, it kind of is looking like it's setting up for another fall here, is kind of my assumption. And you know, obviously, if that changes, I'll be happy to share those changing thoughts with you as well. In terms of other charts on the board that are pink alongside real estate, we also have consumer staples. Both of those have a pink background color because they have what's known as a weekly bearish posture at this moment in time. But the staples are kind of interesting to me here, I must admit, sitting right on their upward trending 30-day moving average. Now, part of it is you got to be careful when I tell you things like, hey, the staples interest me, because staples always interest me. I'm a dividend growth investor, so it represents the largest portion of my own personal stocks out there. So you got to be careful with who's telling you this. But even if I put that aside and just try to look at this objectively, you know, what I see is a chart that was breaking out to the upside around this level. We broke out of this kind of prior double top. We went up a little bit too far to the point where we actually got an overbought cluster signal. Now this is the reversion to the mean move back. And now the expectation is kind of the opposite of oil, which is this is an upward trending moving average where if you're looking to start spreading some bets in the staple space, I don't mind this location. I wouldn't mind the idea of playing for the upside here. Of course, it is a more defensive area. So that could be a place where people kind of go to hide if the markets get a little bit more chaotic there as well. All right, let's get into our trade application example. Before we do, just notice that the healthcare sector remains strongly bullish with that dark green background color there. And I've already kind of given away what the ticker symbol is, but let's just kind of get into the meat of it here. I'm going to pull up chart 2A, and the ticker symbol is Amgen. And again, that came in as a question to me from, I believe it was Krishna earlier today. And he was just wondering if, you know, this is an interesting dividend growth investment. And I said, yes, I personally believe that it is. In terms of a lot of different ways that we're looking for dividend growth investments, Amgen provides a lot of those, or ticks a lot of those boxes for us. It has a high yield. It's currently yielding 3.18%. Typically, it only yields about 2.74% at its higher areas. So we view that as an attractive territory, which is why it's trading here in the blue zone. You can also see that its payout ratio is only 43%. That is very, very low by most standards. In other words, you want that number to be further down away from 100% because it gives you the impression that the company has more firepower to raise its dividend in the future. So I don't see any red flags, and I don't fear that Amgen is going to come out with a surprise dividend cut. Now, obviously, anything's possible, but just judging by the numbers, it looks pretty strong from that perspective. In addition to that, we have a PE ratio of only 13 times earnings, according to the Thinkorswim platform. And so that is considered very cheap in today's market. And you can kind of see down below here, this brown line is tracking the PE ratio over time. And you can see where we stand right now is on the lower end of the scale from where we've been trading in recent years. So it's cheap not only to the market, but it's cheap to itself over time. And of course, with the S&P 500's dividend yield of only 1.3% and the 10-year Treasury's dividend, or an interest yield, I should say, of 1.34%, this stock, in comparison at a 3.18% yield, looks mighty attractive. You'll also notice down below here that the earnings per share that they just reported is the best in the company's history. $4.38 is what they just reported here back at the beginning of August. So this is not a situation where this is a desperate stock that's plunging because its business model is not working and you're getting an accidentally high yield as a result. This is a situation where the stock is firing on all cylinders, or the business is. It's just that the stock right now, for whatever reason, is unloved by the market. Now, the icing on the cake for this one is the fact that you have this little green dot showing up underneath this week's candle. Now, this is a weekly candle chart. It's actually a bar chart, but point is, this is a 10-year view that we're looking at right now, and each one of those lines you see represents 1 week in time. Now notice that this little green dot does not appear anywhere else on the chart. In other words, this is the first time in a decade that Amgen has an oversold cluster signal on the weekly candle chart. That is a pretty emphatic statement. This is a company that rarely gets oversold. This is one of those unique moments in time. You can also see where this stock closed here today is basically exactly where it was trading at its lows back here on the week of March 1st. So you might have that potential for a double bottom around that area, in addition to having an oversold cluster signal. So a lot of positive features here for this very high quality Dow Jones Industrial Average stock called Amgen. And not only do you have really interesting valuations, attractive dividend yields, a high quality nature to it as a blue chip status in the Dow, but you also have a technical reason from the market forecast to become interested in it with that oversold cluster signal there on the weekly candle chart. So with all of that in mind, what I chose to do in this case was to sell a put on it. Now, some of you might say, well, don't we already have that trade on? We did. This is one of those catch and release situations. If you're a fisherman, you'll know what I'm talking about there. So we did sell the put. We did sell a put on Amgen a month or two ago, but it just rolled off our books last Friday with the August expiration monthly contracts there. So we're now in the opportunity to go fishing once again in this pond, and I don't have any issue with it. So what we ended up doing was selling the 205 October put, which for those of you that are newer to this style of a trade, what that does is it puts me on the hook for buying 100 shares of this stock at $205. Notice that it's at $221 right now. So I'm now on the hook for buying it at $205. In exchange for that, I receive approximately 1% of the strike price. So let's call it close to $200 that I would have received for selling that put. So I get money up front for my willingness to buy this stock at a lower price down the road if push comes to shove. Now, this is a higher price stock, so you do have to keep that in the back of your mind as well. Perhaps some of your position size doesn't suggest that you should be taking on that much risk. But for those of you that have a large enough account that's willing to take on a position like that, or at least work through the trade, I think this is an interesting example of a high-quality dividend growth stock where we have attractive valuations, oversold conditions, and be willing to kind of latch onto this company at $205 per share, which of course would mean the dividend yield would even be bigger at that point than it is right now. So that trade was done during the normal market session. The exact trade details were sent out to all of you who are premium members via the Telegram app. So make sure you're looking for that if you want more information, but hopefully that explained it pretty well. All right, that's what I had here for you today. Again, tough day for the news flow. Thinking about all the military families out there. I hope those folks that are affected know that we support them, and I hope that we can try to save future lives and maybe learn from whatever happened here today. But here in the stock market, it looks like the market did sell off a little bit, but we do remain with bullish postures for the time being. So if you got value out of tonight's video, do me a favor, go on over to Twitter, click like for me there. David should be back with you tomorrow, and then I'll plan to be back with you next week at some point. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.